Good afternoon. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, and happy Friday to everyone. And what a Friday is as Chris Dearborn of Nasdaq's Market Intelligence Desk joins me on set. Thank you, as always, for joining us. And Chris, we actually have a different narrative to talk about today.
We absolutely do.
So my question to you is, this week's action is we finally got some volatility back in the market. Great thing for those traders out there, but the key question is, was that a pause in the bull market, or do you think this sets up for a trend change?
I absolutely think it's just a pause. I think you're seeing a sector rotation. You're seeing a little bit of profit taking across the board. You've had earnings come in the last couple of weeks, and you've had almost 90% of all companies report so far. You've seen earnings growth that's significant quarter over quarter. You've got so much out there that would give it a pause that any saber rattling that you're seeing from the president and what's going on in North Korea is really just a blip.
Right. It was really interesting to watch the action prior to on Tuesday when he was making those comments from Bedminster. You just saw the S&P from the beginning of the session go 10 point, move up those 10 points, all-time high, all-time high, all-time high.
Right.
And it got to, from a couple of traders have told me, that spinning top formation, and then it just fell out of nowhere following these comments. We have really, I feel like we've only seen this type of action once a month. We saw it in May, we saw it on June expiration, we saw it one day in July. It seems to happen on Wednesdays with the exception of June's expiration, but it seems to follow that pattern this summer where it's been one blip in the middle of the month.
Absolutely. You've had the Dow Jones Industrial, which is really the Main Street Index, the Main Street USA Index, make an all-time high on Tuesday. The S&P 500 made an all-time high on Tuesday as well, a better gauge of the broader market as a whole there. And since then, you've really seen a little bit of a sell-off. So if you look at the percentage move from where the S&P and the Dow Jones were from Friday of last week to where they were coming into this morning, and we're not even talking about today's rally, the markets are up anywhere from 1/4 to 0.5% today. You know, they're off less than 1.5 to 2%. The worst performer was the Nasdaq Composite, down over 2% coming into it.
But it's been leading all year long.
All year long, right? Why can't you take a pause and take some profits?
Right.
You know, and from there, from that all-time high made on Tuesday to the sell-off, it was even, inconsequential, really. And what you're seeing with the sector rotation is that you're seeing people taking profits on earnings. You're seeing stocks absorbing that excess supply coming into the market and taking a little bit of a haircut. And with that haircut, there's nothing wrong with the markets as a whole. You always look as a trader for volume to validate the move. And volume this week, even with the percentage move and the spike in the VIX, has been extremely light. So I don't buy into it. Monday's volume was not, for the consolidated tape, wasn't even 6 billion. Tuesday's volume was a little over 6 billion. Same with Wednesday. So you have that big sell-off coming into that. Thursday volume was a little bit higher, with just over 7 billion shares on the consolidated tape, but you had a lot of earnings that day adding to that. And then you've had some economic numbers come out as well. Everything's kind of status quo. CPI and PPI came a little bit light. Consumer Pricing Index and Producers Pricing Index, which are released by the Labor Department here in the U.S., and they came in a little bit light as well. So what you're looking at really is a mixed bag of nothing.
Right. Same thing, too. If we go back to VIX levels, yes, the headline number, the percentage move does look big, but you still, I think it was, 17 pre-open this morning?
We hit a 17 handle today.
You're still below the historical average. It's just that headline number of, the VIX almost doubled within 2-3 days.
You're grasping at a percentage move where it's really inconsequential.
Right.
The VIX has gone from a leading indicator to really nothing more than a post-market validation of what is really happening in the markets. And as the VIX continues to spike back and forth, I mean, if it would have held this price point, the VIX was at 10 early in the week, even below at 9 and change, and it hit a 17 handle. That's a 70% move. Well, you're jumping, oh my goodness. Volatility's back in the market, but then you see it back off. It's trading at 15 again now. So you've had almost a 20% decline from the high. So you could take that percentage move and put it either direction. I like to see volume into the markets. If we had a $9 billion share day yesterday on the consolidated tape, that would have validated the move, and I would be a little bit nervous here. Just over 7, that's an average, and you had earnings as well as economic data, and with that, really, I'm not concerned.
Right, and that's what I want to wrap it up with as well. Outside of retail earnings, they were really not quite that good to wrap up this week. Over 70% of companies have been beating on the top and bottom line. The second quarter was quite impressive. Economic data outside of CPI and PPI, but going into this week was pretty good. Do you think that sets us up for another rate hike for 2017?
Good question. So what you've had is the consistency in the labor market. Non-farm payroll last week, you had unemployment first time and continuing claims coming this week, all in line, and non-farm payroll last week was even better. Wage growth has been a little anemic. That's really kind of where we want to see an increase, a tick up in there. Wages, so what kind of goes hand in hand. If you have wages not really increasing, you're not going to see the consumer price index really increase because people aren't going to be spending as much because they're not making as much year over year. It's 2.5%. It's a good number. We're looking for a little bit more there. So what happened was the Fed fund future rate coming into the non-farm payroll print the last Friday was at about 35%. After the non-farm payroll print, which was a surprise upbeat number for the number of jobs being created, spiked over 40%, 42%. And then once with the CPI and the PPI number coming out yesterday and today, you saw that slide back down to 33%. And that's, remember, there's only 3 meetings left for the Fed for the year. Each meeting is a live meeting where they can adjust rates. So we're only standing at basically a third, 33% of maybe raising the rates. More interesting to me is what they're going to do with the balance sheet and once the tapering starts September, October, with that first wave of $10 billion, bring $10 billion worth of assets being put back into the market. I think that will give people pause just to see what and how that the market reacts to that, because the market doesn't like uncertainty. And that's why the comments out of the Oval Office and from Asia make things a little uncertain. I think it gives it a little bit of pause. But all in all, the markets are still marching along very strongly because you still have money coming in through ETFs and Main Street investing. So that's going to be the backbone of this market to move higher.
I'm actually doing a segment next week for options expiration on ETFs.
Oh.
Are ETFs taking over the world? So that should be an interesting one. Make sure you guys are staying in tune for that. And thank you, Chris, as always, for joining me.
Absolutely.
And thank you guys for joining me. Have a great weekend. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.